Hey guys, Tish here from Black Sheep Finance. I'm hiding in the back of one of my dry cleaning shops, as you can see. So today I'm going to be doing a live Q&A with my accountant. So I guess to determine whether any professional is good at their job or not, you have to kind of almost be in a difficult situation, because my previous accountant I thought was good, but I ended up getting in some hot water with my businesses simply because they weren't doing the right thing. And sometimes you don't know if someone's doing the right thing or not until shit hits the wall, basically. So Paul has been a friend of mine for many, many years, and he's been an accountant for over 25 years, and he knows his shit. He's also a beautiful, beautiful soul, a very, very good person, and I think what makes someone really good at their job is when they care, when they genuinely care about you and your situation, and they want to help, and they'll do anything to help you out. So I've been getting quite a few different tax-related questions, so rather than try and give a vague response, I thought we'd jump on live and get the answers direct. We've had a bit of technical difficulties, so we haven't got a video feed with Paul, but we do have him on Skype, so you'll hear his voice in the background. So unfortunately you won't see this beautiful face, but I will post some links where you can get in contact with him, and I'll tag him in this post, so if you want to see what he looks like and check out his business page, then you can do that. So you want to say hello, Paul?
Good afternoon, everyone. Hi, Tish. How you going?
Yeah, good, thanks. So...
Yeah, thanks for the opportunity to have a chat.
That's all right. Well, we'll jump straight into it, because I know you've got heaps of points back to back today, so thank you so much for being able to squeeze me in. The first question we've got is, this question I get asked a lot, and I'm sure you get asked this a lot as well, is when capital gains tax becomes applicable on your own home. So this particular situation, I've got a client who they lived in their own occupied home, and they've since moved out and turned that into an investment property, so they're claiming all the deductions on it, and they've been out of home currently for about 3 years. So if you can just talk through, I know there's some rules that you've mentioned the name of, where like there's a time limit perhaps on how long it can be out of home, and if you move back in, what those sort of timelines are. Can you go into that for us, Paul?
No problem. No problem at all. It's a very common question that comes up regularly, and fundamentally what you're talking about, Tish, is what's called the main residence exemption. And the main residence exemption applies basically where if a property is has a period of absence, whether it's rented out or whether it's not rented out. So primarily, if a residence is not used for income-producing purposes, when someone moves out of the property, they can continue to treat that property as their main residence indefinitely, on the assumption they only have one main residence. If they go and buy another property, there's some issues about selecting which one is the main residence. In your example where someone's lived in their home and they've been out of it for 3.5 years and they've been treating it as a rental property for that period of time, the maximum period that they can do that is up to 6 years. So in that time, if the property is treated as the taxpayer's main residence and they rent it for a maximum period of up to 6 years, at that point in time, there'll be an absolute CGT exemption if they then sell that property. If they go beyond that six years, then there becomes issues around pro-ratering of capital gains tax. But fundamentally, to answer your question, if it's rented for a period of 6 years and it is their main residence and they don't have another main residence, it'll be exempt from capital gains tax on sale.
So why is it that so they won't have capital gains? Is that what you're saying? Because they've only got one property?
Correct. Yes. The main residence exemption rules apply to the fact that you've got one primary residence. So where it gets a little bit complicated is people own their family home, they rent the family home out, and then they go and buy another property that they're living in. So that's where they'll need to sit down and seek some advice, and sit down and sort of map out the circumstances, map out the values of the properties and look at what they're doing to try and work out which one will they elect to continue to be their main residence for the purposes of capital gains tax exemption.
So hypothetically, if this person did buy another property within that 6-year period, but then at
Yep.
the time that they sold the property, they only had one property, would that still be exempt?
So it gets a little bit complicated. So if they've got two properties at a particular point in time, someone will need to work out which is the best one to elect to be the principal residence within the main residence exemption rules over the period that they owned dual properties. So in your example, they've owned one, they've rented it out, they've bought another one, they've sold it. At some point in time, there'll be a crossover. So that's where someone's got to sit down and work out which is the best way to go, which is the best property to elect to be the tax-free property.
Okay, so you can only ever have one tax-free property, essentially.
Correct. Fundamentally, yes.
Yeah. Okay. Interesting. I don't even know that one.
So the main residence, the main residence exemption fundamentally talks about if a dwelling is not used for income-producing purposes when a taxpayer moves out, the taxpayer can treat that dwelling as their main residence indefinitely. So that's on the assumption they don't have another residence.
Yeah.
If it's used to produce income, i.e. it's rented out, it can be treated as the main residence for the main residence exemption for a period of up to 6 years whilst it's used for that purpose. And again, assuming there's no other residence. So where it gets complex is if either of those situations occur but someone else buys another property, again, someone's going to need to sit down and look at which is the best property to elect to be the main residence for the main residence exemption calculation.
So it doesn't really matter, because that was coming into my second scenario, where it doesn't really matter whether that person makes a claim against that property or not for tax purposes. It's more about, because I've got another client where they are choosing not to claim or declare anything in their tax about the property because they're hoping to avoid capital gains tax. But essentially, whether you claim it or not, if you've got another property that's your residence, it's kind of the same ruling.
Correct. That's a really good question. So you've got property A, you've lived in it, and you're no longer living in it, and you now own property B. But property A, as you've said in your example, is not generating rental income, but there's expenses being incurred. So where it gets a bit messy is those expenses are being incurred. So let's say in the initial property, someone's still got a mortgage on that property, and they're paying rates and insurance and holding costs. Those holding costs are able to be used to reduce any capital gains tax if that property is the one that ultimately the person chooses not to be their primary residence once they work through their numbers. So yes, it's actually irrelevant whether it's being rented or not rented, because you can only have one primary residence that's exempt. Renting it out or not renting it out doesn't mean that it's exempt from capital gains tax.
Interesting. So, because a lot of people, I'm sure, are trying to find a loophole.
It's a very common issue.
Yeah, they're trying to find a loophole, so therefore thinking, if I don't claim it, then I don't have to worry about capital gains. But obviously, that's still in effect whether you choose to make the claim or not. So essentially, you might as well take the benefit of all the expenses and get it back in your tax, because it's the exemption.
Yes, if you can meet the conditions that it's a rental property.
Yeah.
So I'll give a similar type of example. So you own your family home and you're living in it, but you've got a beach house. And you're not actually renting out the beach house, but you own it for, say, 5 years, and you buy the beach house for $300,000. And over that 5 years, you've incurred interest and holding costs that might come to the sum of $100,000. So you've got a cost base of $300,000, holding costs of $100,000, and then you sell that beach house for $550,000. So you've got a sale of $550,000, you've got a purchase price of $300,000, holding costs of $100,000, you've got a $150,000 capital gain. That house, whilst it's not being rented, it's not your primary residence, so it's subject to capital gains tax. So in my example there, you have a capital gain of $150,000, and you get a 50% capital gains tax discount because you've held it for longer than 12 months, so you have a $75,000 taxable income. So it's a similar scenario to if you've owned a family home and then you move into another one, but you've got an original asset. The only complexity in that example, you've got to choose which one is your primary residence. So people get in this situation a lot, and my strong recommendation is they just really need to sit down with an accountant, talk about the machinations around their personal circumstances and work out which way is the best way to go.
Yeah, definitely. Just for those people who don't really know what we're banging on about with CGT, so if you just want to quickly explain, very briefly, what capital gains tax is, and a lot of people need to, I think, understand that ruling around the 1 year, where, you know, it's 100% versus when you get that discount. So you just want to give us a brief overview of that?
Sure. Capital gains tax is not a separate tax. It's a tax on a gain on an asset, and the income that is derived as a capital gain gets added to the taxpayer's taxable income. So in the example, I'll use, say, myself as an example. So Paul is working, he's on a salary of $100,000 a year. I own an investment property. I buy that for $400,000 and I own it for a period of longer than 12 months and I sell it for $600,000. I've got a $200,000 capital gain, and because I've owned it for longer than 12 months, I get a 50% capital gains tax discount on the $200,000. So I have $100,000 capital gain that is taxable income. The property is owned in my name, so that $100,000 taxable capital gain will add to my salary, which was $100,000. So I have a $200,000 taxable income, and I will pay tax on the capital gain at my marginal tax rate. So in my example there, at $180,000 is where the top tax rate kicks in. So I'm going to be looking at paying some proportion of tax at the top rate. So fundamentally, the key thing for most people is understanding that number one, the CGT discount is applicable where you own an asset for longer than 12 months. If you hold it for less than 12 months, 100% of the gain is taxable. So 100% of the gain taxable, less than 12 months holding the asset, 50% of the gain taxable if you hold it for longer than 12 months, and the taxable gain adds to your income that you've earned in that year that the gain was made.
And this ruling is really important because I had someone ask me in the renovation question, how long is ideal to flip a property? So then obviously we start going into other complex scenarios where the structure of how you hold that property is important, because if you're looking at that and you've bought a property in your personal name, you want to renovate it and flip it within 6 months, if it's in your personal name, then obviously you're going to be having that CGT event.
Correct. That's where tax planning is very important. You need to sit down and look at your personal circumstances, whether there's some opportunities to look at owning the development or the investment in perhaps a trust rather than in your own name. And again, there's so many different variables here depending on someone's personal situation. So my advice to anyone thinking about doing property investment or property development is engage with their accountant, or if they don't have one, find one they can talk to and sit down and plan what they're proposing to do so they can make sure that they get it absolutely right. A few dollars spent initially may well be worth tens of thousands of dollars in tax saving down the track.
Yeah, and it's massive. Like, it's really important, guys, that with any property, you have to figure out what you're doing before you buy the property. So many people come and see me after they've bought it. So it's really important, like, if you have to know what you're doing in the next 5 years, you've got to have sort of a plan, you've got to know your numbers, because how you buy that property, the entity you purchase that in, whether it's your personal name, company, trust, etc., it's not easy to change it later. You've got to do it correct at the start. So you've really got to plan ahead, know what you're doing, get all the advice up front, you know, knowing what your borrowing capacity is, and obviously all the tax implications of the end result, what you're going to achieve as well. So we've spoken briefly about renovation there. Another common thing I see all the time, everyone thinks it's a great idea, oh, I'm going to buy this big block and then sometime down the track I'm going to subdivide it and build to and sell. I hear that all the time. Unfortunately, in most cases, it's really difficult to make money in that situation. And when you are looking at demolishing a property and subdividing, you have to understand, again, like you need to have long-term perspective because you've got all these implications down the track. So you've got to know at the front what your eventual plans are. Even if you're going to do it in 5-10 years, you've got to set it up correctly at the start for the loan and the ownership structure, and do the numbers. Always have to do the numbers. And one thing that I see a lot with this whole development idea, you've got to have a lot of cash because of how banks want you to reduce the debt based on only land value at some point in the future. But more than that, when people ask these questions, they don't look at all the numbers. And one thing which in most cases no one's ever heard of is this concept of GST. So unless you have been in business or a business owner, you don't really understand how this whole GST thing works. And when you start looking at developing, you've got GST implications, you've got GST implications, and you've got capital gains tax implications, which come into developing. Have you got any sort of commentary around that, Paul?
Certainly, Tish. There's a question that comes up on a regular basis through our website in relation to a lot of the things you've just mentioned, and that is, am I an investor? Am I going to be treated in the capital gains tax environment on disposal of the assets on the profit that I make, or am I a developer? And they're two quite separate things. Fundamentally, an investor is someone who buys a property, may do some renovation, rents it out, sells it, and in that example, they'll be treated under the capital gains tax environment. Where the landscape changes a little bit is if they buy a block of land with a house on it, they intend to knock that house down, split that block of land into 3 titles, perhaps keep the one at the front and live in, but sell the 2 out the back. Or sometimes sell one, keep one to live in, sell one and rent one out. So you've got 3 different situations on that one development. From a point of view of are you a developer, the tax office will look at what your intention is and what you're planning on doing. So categorically, if you knock the house down, split the titles, turn it into 3 blocks of land, build 3 apartments on them and sell them, you will be treated as a developer. And that means that you're not in the capital gains tax environment. You don't get capital gains tax discounts. You'll be taxed on the full profit of the development, and there'll be GST issues. So GST issues are really, really important to...
Can I just ask a quick question? With that whole intent thing, at what point do they judge that? Because obviously the tax office isn't having a conversation with you at the start of the project. So intent is really just a discussion, isn't it? So how can you prove what your intent was at any point in time? You just declare, this was my original plan.
Yeah, it's a good question. The issue often comes around what's gone on the loan applications, what discussions have been had between the landowner and perhaps advisors. In an audit situation, the tax office will try and see that. I guess the clear thing is I would normally sit with people and say these are the implications and these are the issues you're going to have to deal with based on what you're telling me what right now your plan is. And as you're well aware, Tish, things change with property. You can start off going down one path and get halfway through it and deviate. And that's quite a common scenario and something I deal with almost weekly. So one of the key things is really to sit down with an accountant and map out what your plan is at that point in time. If it changes, having an understanding about the implications of that changing down the track. GST is a really significant issue when you're looking at intent, because if you're an investor and treated under the capital gains tax environment, GST is not an issue. However, if you go down the pathway of a particular project and you don't register for GST, but in a look-back situation, the tax office think that you really were acting in the capacity as a developer, you can have some really unfortunate situations. And there's a lot of case law around people that have gone and done a development, and the ATO have come along knocking 3 years down the track and argued they were a developer, not an investor, and hit them for hundreds of thousands of dollars of GST liabilities. And at that point in time, often the properties are sold and there's no ability to recover that GST from the purchaser. So it really, really is important if someone's thinking about going into a development where there may be some different scenarios, I absolutely urge them to spend an hour to an hour and a half with an accountant and run through the scenarios and make sure they're crystal clear. Because as you alluded to before, I often see people who have done it and coming in at the end, and there's all sorts of issues sometimes that are not fixable once it's all done.
And you can't really, I guess, register for GST at the end and then sort of backtrack, can you? Or is that possible?
No, you can't. You absolutely don't want to be doing that. If it looks, feels and smells like a development, the accountant will advise you to register for GST from the start. The primary reason being that you'll be entitled to claim the GST back on the construction costs as you go through the process. So that's a cash flow benefit because it'll be getting some money back to help finish that development. But you'll also need to know then the implications of selling when you plan to sell, because there'll be GST applicable on the sale of the development. And there's various rules around that which people muck up all the time. And one of the rules is called margin scheme, which is a rule that talks about how you calculate GST on the sale, where a margin can be applied to reduce the GST. I'll give a really, really simple example. You buy a block of land with a house, just say a block of land for $500,000. You develop 3 townhouses, that costs you $1 million. So you've got a $1.5 million cost, and you sell those for $2 million. So in my example there, you've got a margin, you've got a sale of $2 million, you've got a $500,000 cost on that land that when you purchased it, you didn't pay GST. So you're allowed to use that margin to take that off the $2 million. So your GST will be applicable on $1.5 million divided by 11. So that reduces the GST payable on the sale. What a lot of people fail to do is understand that that's out there and there's an issue, or when they have their contracts drawn, they fail to tell their conveyancers or lawyers that margin scheme has been applied, and they fail to tick a box. If they fail to tick that little box, it means GST is applicable on the whole $2 million, not on the margin. And I have one of these as a real live example at the moment, where we have a client who has failed to tick that box on a $3.3 million property, and the tax office are now chasing him for an additional $100,000.
Ouch. I guess it always pays to do the homework up front and tick the right boxes, doesn't it? Wow.
It absolutely does. So I really encourage what you're doing here, Tish, helping people out, because probably the message that anyone watching, listening to this now is finding out, it's a bit of a minefield. It's not overly complicated, but you do need to seek really, really good advice. So for me, I'm talking to anyone going into property, whether it's their first property or their second one, or they've got multiple properties. The key thing is find a good broker, such as yourself, to help get the right type of loan, make sure the finance is structured correctly, and then get a good accountant to make sure the structure and the tax planning around that works. Because at the end of the day, you're going to put your blood, sweat and tears into trying to make a profit, and you don't want to give money away unnecessarily to the taxman at the end of the day.
Yeah, absolutely. And it's not, a lot of people I think try and do it dodgy, but you can still ethically and legally find loopholes that work in your favour, but to try and, I guess, scam the tax department, no one's ever going to win that way, and you can't really escape the ATO, can you?
Look, the ATO data matching, so I've been in practice since 1992. The ATO data matching systems are very, very, very sophisticated, and they do analyse data from the various state revenue offices around the country. They'll look at property transactions and property sales, and please explain letters do come out. So I guess at the end of the day, my advice to anyone is, if you want to take a risk, be that the choice that you make. But my professional advice is sit down, seek proper advice. It's not going to cost you a fortune. It might be just a few hours with your accountant, making sure that you understand the implications of what you're doing, and you've ticked all the boxes and you've got everything as right as you can possibly make it. Because at the end of the day, a prudent investor or a prudent developer will sit down and make sure that they've done all of those things.
Yeah, absolutely. Well, thank you so much, Paul. I'm sure I've got a million other questions I can ask, and so does everyone else, but I don't want to keep you longer because I know you've got appointments. So thank you so much, Paul. You're a massive help. I'll post links to...
Thank you, Tish.
No worries. I'll post links to Paul's website in this post. And the critical thing is that there's so many different questions for everyone's situation. Everyone's situation is unique. So you need to have the conversation. You need to know what you're doing up front and get the right advice. Obviously, I talk generally a lot because I can't speak about anyone's situation unless I actually know your numbers. Same with Paul. His advice is in a general nature, but he's licensed to actually talk exactly about tax issues. I can only ever talk generally, so it's important to speak to the right people. And Paul is definitely one of those people. He's saved me literally thousands of dollars in helping me out with my businesses, and it's important to get the right advice. So hopefully this has been of use to you guys. And if you've got any questions, either post them below. And if you want to chat to Paul, then contact me first and I'll introduce you and he'll be able to help you out. Thanks, guys. Have a good day.